Alrighty, everybody, what is going on? Welcome back to another quick CYPRX fundamental video breakdown. In today's video, I'm just going to touch on this week's fundamentals, do a quick weekly wrap up on what took place this week and why we've seen support at the $3 trillion mark for the total cryptocurrency market cap, and then what to expect moving forward into tomorrow, and then what to pay attention towards this weekend. If you guys enjoy these quick video breakdowns, do me a favor, smash that thumbs up button and subscribe. This is just going to be completely raw. I'm not going to edit this. I really want to dive in and share with you guys what we go over here in the private CYPRX community to keep our community engaged, awake, and aware to what is really happening behind the scenes, the fundamental drivers that actually move these markets. Yes, there's a whole bunch of bullish fundamentals outside of these intraday fundamentals that come out, like relationships, projects happening, partnerships, announcements surrounding ETFs, institutional adoption, and whatnot. But these are more so oriented towards intraday fundamentals surrounding central bank policy, geopolitical escalations and tensions, trade wars, tariff implications, things of that nature. The things that these large financial participants like UBS, JP Morgan, Blackrock, and the list goes on, the fundamentals that those institutions actually pay attention to. All right. So real fast, I posted this for you guys today because we had two really good, phenomenal Zoom calls. And so in this post where I said, tap into our private Discord community, we have 2 to 6 weekly Zoom calls. And today we held 2 calls in one day. We covered crypto market fundamentals, the 2025 market outlook, DeFi yielding opportunities. We talked about real estate tokenization opportunities via some platforms that are coming up and some ones that we're already interested in utilizing now. And then we also talked about crypto debit card yield opportunities, right? So again, if you guys want access to these calls, to join a community of like-minded individuals, ask questions and engage in open spaces where we talk about the market fundamentals and all of these things, tap in with us. We'd love to have you on the team. So because I got asked the question in the DMs, when you're talking about crypto fundamental, Cypress, what are you referring to? So I'm just going to read today's Asia session report. I hand type out these reports to the private community members, either during Asia or New York session, to keep them updated and fluent with the ongoing fundamentals, what to pay attention to that day, the day before, what happened that day, and then what to be paying attention to the days to come. So that way we're always playing chess with the markets. We're not just guessing or trying to wonder with our heads cut off like a chicken running around what's happening in the market, why the market is down $100 billion for the day, or why the market's up $100 billion for the day. We're always engaged and we're always aware of our environment, whether that environment be risk on or risk off. So nerd out with me for a little bit. Again, if you are new to this and you've never heard a fundamental breakdown, this might be a little bit eerie for you. But if you've been part of the CYPRX community, you've been following us on the YouTube space, then you're most likely aware that we cover these things in a private community. So tap in, because this is a really good report. Because throughout the entirety of this week, I was under the impression that if we saw higher inflation, we were most likely going to see sell pressure on risk assets, because that was going to lead to a pushback in interest rate cuts from the Federal Reserve. However, this week, even though we saw higher inflation readings in both CPI and PPI figures, we are still seeing rate cut bets remain on the table. And so today's report that I hand typed out for the community members really dives into that narrative. So let's break this down, because outside of the rate cut narrative, there are other supporting fundamentals that are helping prop up the digital asset space for now. And again, we'll get into the forward-looking projection towards the end of this report. So hopefully you guys can see this. I'm just trying to see if the print's looking a little fine. Let's go ahead and zoom in just a little bit more for you guys. All right, so February 13th, I'm just going to, again, thoroughly read through this. I'm going to try to keep this short. Hopefully I can get this video under 20 minutes. No editing. I'm just going to straight upload this right after I read through it. So if I stumble on my words, I'm just going to recalibrate and keep going. The crypto market is showing notable resilience, holding firmly above the $3 trillion threshold and currently trading around $3.1 trillion at the time of writing this report and recording this video breakdown. Despite a brief sell-off following higher than expected core CPI data yesterday, because as of time of recording this video breakdown, it is Thursday evening, my time here in the United States, the market quickly recovered. And again, this was yesterday. The Federal Reserve Chair Jerome Powell calmed investor nerves by emphasizing that one elevated inflationary reading does not alter the Fed's confidence in reaching its 2% inflation goal, as you guys can see here via this X post. Under the current rate environment, This helped reinforce hopes of potential rate cuts, with markets clinging to the idea of Fed rate cuts in 2025 remaining on the table. Here are some other supporting fundamental factors that help prop up the crypto markets above $3 trillion. We had peace talk proposals. Reports indicated that China has floated the idea of a summit between Russia and President Vladimir Putin, along with President Donald Trump, to discuss ending the Ukraine war if successful. De escalation would likely reduce the demand for the US dollar as a safe haven asset, a key factor supporting the dollar's strength since 2021, thus potentially boosting risk assets such as cryptocurrencies. Then we also had tariff threats. Trump is again expected to announce details on reciprocal tariffs, but similar threats in the past have often been delayed. Markets seem as though they are starting to grow accustomed to these repeated tariff threats and have shown muted reactions. Now, it is my personal opinion that any unexpected implementation or escalation of tariffs could introduce new volatility to the markets. I only see tariffs severely weighing on the markets if the threats actually turn into reality. So these are just two developments that took place, excuse me, over the last 48 hours that have helped prop up risk assets. So we had peace talks amongst Russia and President Donald Trump surrounding the Ukraine conflict. The Ukrainian conflict has been weighing on risk assets and strengthening the dollar pretty much since 2021, right? So that would be a significant change in market sentiment if that peace agreement actually came into fruition. And then also, you can see here in this tiny piece from fxstreet.com reads, the United States President Donald Trump is expected to deliver his latest batch of tariff threats during the back half of the U.S. market session. President Trump is slated to reveal details of his planned reciprocal tariffs on any country that has their own tariffs on U.S. goods. But according to a report from Washington, D.C., this can get preemptively kicked down the road with reciprocal tariffs not expected to come into effect for some months. Markets are getting used to brushing off trade war threats from Donald Trump, and this represents the fourth consecutive time that the Trump administration threats of imposing steep import taxes on foreign goods have been announced and then delayed. So the market's kind of getting tired of being threatened, and it's like, well, if you're not going to do it, then we're going to continue to buy risk assets in a nutshell, right? That's at least the way that I'm seeing it. Then the inflation outlook. So over again, the past 48 hours, we've got CPI. I already talked about how, yes, the CPI data came out, but Jerome Powell eased investor uncertainty when he said, you know what, one high inflationary report is not going to deteriorate the overall trajectory that we have, that the Fed is going to be able to achieve the 2% inflation goal and continue to cut rates later this year, right? Then today we had the PPI figures. So core U.S. producer price index, or the PPI inflation for January, came in at 3.6% year over year. This is going to be extremely important, and I've seen no other retail fundamental analysts on the internet cover data the way that we do here in the private CYPRX community. So pay attention to detail. This is going to teach you something if you are interested in learning about fundamentals and how to gauge the trajectory of what these fundamentals can cause or create in terms of a market environment, risk on or risk off. So PPI figures, core U.S. producer price index inflation for January came in at 3.6% year over year, surpassing expectations of 3.3%. So yes, we're still seeing some elevated figures. However, the previous period was revised higher to 3.7 from 3.5%. That final figure still represented a slight decrease, easing immediate fears of inflation resurgence. So while the rest of the retail crowd is seeing that higher inflation came out today, here at CYPRX, we were paying attention to that there was an actual revision that allowed and eased investor certainty, or allowed market participants to continue to price in rate cut bets. So let's explain this revision in detail. The slight decrease in this revision, or this slight decrease in inflation, refers to the fact that January's PPI reading at 3.6% ended up slightly lower than the revised previous month figure at 3.7%, even though that older figure was itself revised upwards from 3.5 to 3.7. So here is a step-by-step breakdown of that. 1, the initial previous PPI reported at 3.5%. 2, the revised PPI later updated to 3.7%, a revision based on more complete data. And then 3, the current PPI released at 3.6%. So because the 3.6% PPI, which was the PPI that we got today, is below the revised reading that was revised today as well, up to 3.7%, still represents a small decrease from 1 month to the next, although it's higher than the original forecast of 3.3%. This tick down from 3.7% to 3.6% helped calm fears of continued accelerations in inflationary figures. Even if it's still elevated, markets often focus on the direction, either higher or lower, and the momentum getting hotter or cooler. In this case, the direction moves slightly lower from the updated figure, which contributed to the idea that inflation is not spiraling upward and that the Federal Reserve might have the scope to consider cutting rates sooner rather than later. Obviously, of course, i.e., keeping rate cut bets on the table. All right. So I broke down for the community members why this revision matters. Revisions are updated calculations of previous data releases, accounting for new information or corrections. In this case, the revised PPI data suggest inflationary pressures may not be as severe as initially feared, reinforcing again the possibility that the Federal Reserve might begin cutting rates earlier, potentially in September rather than in December. Importantly, this did not prompt a sell-off in risk assets because the market perceived that the final figure is lower and supportive for a more accommodative monetary policy stance in September instead of what was previously priced in, that we were only going to see one rate cut this year and that wouldn't be until December. The markets are actually now pricing in a rate cut to happen and take place in September of this year, right? So to continue, last but not least, we had institutional commentary. So BlackRock today, BlackRock this week, we have the JP Morgan fundamental that came out today, but BlackRock 2 days ago, the asset management giant released a statement affirming its core risk-on framework, citing both a robust macroeconomic backdrop and the structural tailwinds of AI as reasons to remain overweight in U.S. equities. Here you can see this posted directly from their LinkedIn profile. It says here that they're tweaking their views yet staying risk on. And this is coming from one of the largest financial participants in the digital asset and risk asset ecosystem. Okay. And they're literally posting on their LinkedIn profile that they still remain risk on, right? So that was interesting to see. And another supporting fundamental factor. JP Morgan wrote in a report today, JP Morgan strategists maintain that inflation is likely to moderate enough for the Fed to cut interest rates this year. These perspectives underscore how, despite temporary market setbacks from strong labor market data and moderately higher inflation readings, ongoing peace initiatives and stalled tariff measures are bolstering risk sentiment. So, obviously, of course, if large market participants like JP Morgan and the Federal Reserve are all confident they're going to still be able to cut rates this year, that is going to keep markets hopeful, right? We know rate cuts usually tend to lead to increased risk appetite or at least some moderate support for risk assets like crypto. So to wrap up this report, as long as the total cryptocurrency market cap stays above 3 trillion, the short-term bias still remains skewed to the upside. A decisive break below the $3 trillion mark, however, could trigger a retreat towards the November lows around $2.5 to $2.2 trillion. Here are some upcoming data points that we need to pay attention to. So for the remainder of this week, i.e. tomorrow and then heading into the weekend, all eyes are going to be turning towards the U.S. retail sales data that is due tomorrow. Hopefully at the time of watching this video breakdown, you watch it before the data so you can hear this, which right now is currently expected to show a slight cooling in retail figures. Any softness in consumer spending would likely support the growing narrative for the Fed to cut rates later in 2025, potentially giving another boost to risk assets. Now, beyond retail sales that are set to come out tomorrow, we as market participants should be watching for any sudden shifts in tariff policy or geopolitical tensions, particularly related to Russia and the Ukraine situation or the situation in the Middle East, as previous geopolitical tensions and escalations that break headlines and create market fear, uncertainty, and doubt have tended to weigh on risk assets in the past. A flare-up in either of those jurisdictions could quickly undercut market optimism and pressure risk assets like cryptocurrencies. So for now, the market's ability to stay above the $3 trillion threshold highlights its resilience. Should that support fail, caution is warranted as a deeper pullback could ensue. For now, the market sentiment continues to be supported by hopes for peace talks, delayed tariffs, and more rate cuts to come later this year in 2025. So, in a nutshell, these were some of our talking points from our fundamental Zoom call today. And again, I'm just reading our fundamental report that I hand deliver to the private community members every single day during New York and Asia session. So, if you want access to these reports and you don't want to have to surf the web for these fundamentals and try and figure out what the heck is going on with market sentiment, why today my portfolio is in the red, why today the market's up, what's going on, why is price action bullish today, why it was yesterday bearish, right? At the end of the day, being confused like the vast majority of retail market participants, don't do that to yourself, right? I encourage you guys to get educated on the markets in which you operate in so that way you understand whether the environment that you're trading or investing in is risk on or risk off. As always, many blessings to you guys. I hope that you enjoyed today's video breakdown. If you did, do us a favor, smash that thumbs up button and subscribe if you guys want access to our private community Zoom calls, where we have 2 to 6 Zoom calls per week covering things from fundamentals to DeFi strategies to technical analysis. If you guys want access to our handwritten fundamental reports that I deliver all throughout the entirety of the week, you guys get access to the most accurate institutional delta zones that no other retail community has on the face of this internet, along with hundreds of hours of non-mainstream crypto-related research from some of the world's largest financial institutions that never reach mainstream sources or mainstream media attention. Then tap into the private CYPRX Discord. We would love to have you on the team. As always, be cognizant out there, be aware, and I'll see you guys in the next video breakdown. Alrighty, so before I share screen with you guys, I want this to kind of be an open forum Zoom because this will be our last fundamental Zoom call for the week. We do have retail sales tomorrow to be paying attention to, which is an important economic denominator for Fed path and whether or not they see strength in the overall economy, which will obviously, of course, determine their path towards either cutting rates the second half of this year, or maybe even possibly push back on that depending on how retail sales comes out. I'll make sure to incorporate that in this afternoon's report. But let's just take a look back. Okay. We've gotten now both inflation reports. And I really just want to see if anybody's paying attention before I deliver today's kind of fundamental overview and explain to you guys why the market didn't sell off, right? In previous discussions, we talked about really paying attention to that $3 trillion mark. I even went in detail in a previous video breakdown on a Zoom call and said, look, it seems like every single bad thing that happens in the market that should significantly weigh on prices in the digital asset space have not weighed on prices enough to break that $3 trillion threshold. So it seems like there's a lot of institutional demand around that key psychological level, right? Reason why I say that is because we know that retail investors like you and I aren't holding enough liquidity or digital assets in our portfolio to every single time the market drops down to 3 trillion, buy it back up at that price and then send it back up to 3.4, 3.5 trillion, right? That's not how it works. So there's some type of institutional interest around that area to hold that threshold. And then seeing some fundamentals that I found today from Blackrock that they just posted actually confirms exactly what I was talking about to you guys in previous calls, that even under these market conditions that remain temporarily weighing on prices intraday, and creating these massive outflows of digital assets and risk assets, these institutions still remain risk on. And I'm actually going to physically show you guys 2 large financial institutions pretty much putting out this information. So, but let's just kind of backtrack. Let's talk about the beginning of the week. So what were we paying attention to this week? What things, give me 3 that we were talking about in our fundamental reports from Sunday that could weigh on risk sentiment this week? Somebody give me 1.
Powell's commentary.
Yeah.
Hold on, sorry. You guys are talking at the same time. D'Angelo, go ahead.
Powell's commentary, Jerome's Powell's commentary. That was one of
Okay,
them.
good job. Hawkish, I'll write this down. Hawkish commentary from Federal Reserve speakers, right? Pushing back on rate cut hopes. Okay, that's good. That's 1. Somebody, a lady spoke. I don't know who it was. Who was that?
It was a tariff.
Okay, sweet. Yeah. So what was another one that you said, Annabelle?
Tariff. I said tariff.
Tariff scares?
Inflation.
Let me get my notes out for you guys real quick, just so that way we can have some good talking points. Okay, so we got hawkish comments from Fed. We were paying attention to. All these things could have been factors that weighed on risk assets. And the reason why I want you guys to reflect is because when we go over today's fundamental report, you're going to kind of see why some of these things happened but did not weigh on prices. All right. So weigh on risk. Somebody said tariffs, tariff scares, higher inflation. Somebody said higher inflation, which we did get. However, higher inflation did not weigh on prices, which I'll go over today. Higher
Peace
inflation.
talk.
Okay, good job. We had somebody just mentioned geopolitical tensions and escalations. So we are paying attention to geopolitics, right? Sorry about that. Okay, so four things, right? We don't really need to cover any more. Those were our primaries. We had hawkish comments from the Fed speakers that we were paying attention to. We knew that we had Jerome Powell speaking this week. We had multitudes of Fed speakers sporadically spread out throughout the entirety of the week. Tariff implications from President Trump have been weighing on prices left and right, both in the stock markets, futures, and crypto. Higher inflationary pressures, showing that inflation still remains sticky and troublesome, which pushes back on the prospects of the Fed rate cuts this year. And then geopolitical tensions, any escalations in the Middle East or Russia, Ukraine. Whereas at the beginning of the week, President Trump put out a tweet on his X post or something like that, some fundamental forum or whatever. And he said, like, if Hamas doesn't release all the hostages, he's going to unleash hell on them or whatever, So those were the primaries that we were paying attention to this week. Okay. Fast forward to today. The total cryptocurrency market cap, i.e., a very primary risk asset class, has remained relatively resilient above $3 trillion. Can anybody tell me, let's just focus on comments from Fed speakers. Why did, if you guys read yesterday's report, after the inflation data that we got yesterday, and after Jerome Powell spoke via his second testimony in front of the House committee, why did some of the things that he mentioned alleviate some of the sell pressure that the higher inflation caused? Does anybody know? Did anybody read the report? Can somebody tell me why? Yes, he still delivered hawkish comments, pushing back on rate cuts, where he said we still need to remain data dependent. We're in no rush to cut rates. We're still going to kind of just see how the overall economy unfolds over the next consecutive couple of months. And, we're not going to cut rates at our next meeting, pretty much in a nutshell, right? At the March meeting. He didn't say that, but that's what the market's pricing in. But what was one thing that he said that kind of alleviated the sell pressure from the high inflation? Does anybody know?
Yep.
1 month reading is not enough.
Good job, Richard. Right.
That
So
was
he
it.
kind of
That wasn't
right.
Richard, but
Who was that? Oh, sorry. I saw Richard's highlight. Who was that?
It was
That said
me,
that?
Steve Piker's other.
Okay, cool.
It
Yeah,
was me.
awesome. Yeah, sorry. Richard's
no,
little
I
high.
had the same answer.
Okay, cool. Yeah, both. Hey, look, at the end of the day, we're all on the same page. So good job, right? He pretty much came out during his House committee meeting and he was like, look, at the end of the day, we got a higher inflation reading, but that doesn't deter our path to see or project that we think still inflation is going to reach our 2% goal. So market makers are like, oh, okay, well, if Jerome Powell's not freaking out, right? They're not bringing interest rate hikes back to the table and they're still keeping rate cut bets on the table, then we don't need to panic at the fact that we just got higher inflation. That's the way that I see it from a retail perspective, right? So that's good. You guys saw that Jerome Powell kind of alleviated those higher inflation readings. Okay, tariff implications. Actually, as a matter of fact, let's go to today's inflation report. All right. So again, we did get higher inflation readings today, but does anybody know why the inflation readings from today did not weigh on prices?
Avoiding the recession because the unemployment claims are lower.
Peace
Not
talks
necessarily.
between Russia and Ukraine.
Good job. You guys are both on par. You guys are still both on talking points, but that's not specifically why I just want to focus. We'll get to the peace talks in Russia, Ukraine, helping boost risk sentiment. We'll get to that. We'll also get to the unemployment claims, which did come out slightly elevated. Sorry, excuse me. It did not come out slightly elevated, still came out showing strength in the overall labor market data. But I just want to focus on the PPI data today. What happened in terms of the PPI data today? Even though it came out higher, why did it not weigh on risk sentiment? Does anybody know?
It was strong, but not strong enough to show strength for the US dollar.
Sort of, Camille. You're kind of on the right path. Okay, so I don't know if I've talked to you guys about revisions. So if we look at the fundamental reports, I want to share my screen with you guys real quick. This is something that you guys got to pay attention to, and it talks to you about it or says it on Forex Factory, where it has the actual, the expectation, the previous, and then any revisions, right? So let me share my screen with you guys real quick. Okay, so it says right here, this is just a couple of fundamental pieces. It says core US PPI inflation clocked in at 3.6% year over year in January, well above the forecast of 3.3%. However, the previous period also saw a sharp revision from 3.7 to 3.5%, but the overall tick lower post revision helped gauge the market fears of resurgence of widespread inflationary pressures. And then here, this is another fundamental piece. It says the PPI for January increased by 0.4%, exceeding the expected 0.3%, but came down from a revised 0.5% prior. So overall, yes, the inflation data that came out today was higher, but the revisions from previous months actually was revised lower, right? So this kind of alleviated the fears of, okay, yeah, the inflation came out higher this month, but last month it was revised back to the downside. So this alleviated the pressure of continuing to price into the markets, continuing to price in a pushback on rate cuts. You can see here in the fundamentals, it continues to read, according to the CME's Fed Watch tool, the rate markets are actually now pricing in a better than even odds that the Fed will deliver at least 25 basis points of a rate trim in September. Whereas if you guys remember in yesterday's report, we were only pricing in one rate cut in December. So now, because of the revisions where the PPI came out revised to the downside, the market actually priced in a rate cut in September, which has put rate cuts back on the table at the second half of this month. If you go over to JP Morgan, I read these fundamental reports. I try to share them in the chat with you guys all the time. I've shared UBS's reports, Signum reports, Blackrock's reports, JP Morgan's reports. They put these reports out on their websites and on their LinkedIn profiles, like literally right after the fundamentals come out. This is pretty lengthy, okay? But you can see here in the key takeaways, it says, the latest report for the CPI and PPI does not change our strategies. The expectation that the Federal Reserve will cut interest rates still remains, but it does suggest that the cuts may be delayed to the later half of this year. This is a report from today, February 13th, 2025. So this kind of supports the thesis that I was trying to deliver to you guys in previous Zoom calls, where I was like, I'm noticing that albeit the fundamentals are keeping prices relatively suppressed, I'm noticing that we're not seeing prices break that $3 trillion mark. So there must be large market participants that still maintain this risk on mentality. I remember saying that to you guys in yesterday's Zoom call. And so look at all this jargon, okay? In this report, it's literally talking about, I'll share this in the chat with you guys so you can read it. It talks about the CPI, it talks about the PPI and how it was revised to the downside. But then at the very end, I've told you guys this before as well, at the beginning and the end of these fundamental pieces where they usually drop little gems, it says, our strategies still expect that the inflation data will moderate enough for the Fed to cut interest rates this year. But the strength of the labor market and higher than expected inflation may delay these cuts to the later half of the year, right? If we go over to BlackRock's LinkedIn profile, they posted something just 2 days ago where they said they're tweaking their overall views, but still staying with a risk-on perspective, right? And who's in charge of the ETFs? Who's in charge of, all the pretty much inflows of the digital assets from an institutional perspective? These two large financial institutions, JP Morgan, BlackRock, UBS, all the ones that are actually participating right now. So I pay attention to this stuff, and that's why I try to deliver to you guys, not to panic. Even though we saw higher inflation yesterday, I was telling you guys, it's not really time to sell. The market's not telling us that because for some odd reason, market participants are still seeing optimism that the market should stay relatively risk on. Even though we're still seeing some factors weigh on prices, market makers aren't completely liquidating themselves out of their positions to support risk assets. And I noticed that both in terms of fundamentals and technical analysis. So surrounding inflation, right? Inflation, yes, came out higher both days, but because the PPI figure was revised to the downside today, that kept rate cut bets on the table. And because yesterday, Jerome Powell said, even though we see a higher CPI report, we still primarily depend on the core PCE report, which doesn't come out until February at the end of the month on the 28th, which is a Friday, if I'm not mistaken. And he said one high inflation report does not deteriorate the sentiment that they're going to continue to cut rates. So right now, the market is still holding on to the narrative that the Fed is going to cut rates. So that's why when you're a retail investor, you're a day trader, just because inflation comes out higher doesn't give you the green light to go and take sell positions on risk assets. You have to understand what sentiment drives risk assets, right? And rate cut bets remaining on the table are one of those factors that, if not keeps prices elevated, at least keeps prices at a support level, right? So that was one thing I wanted to bring to the table. Somebody else did mention the alleviated pressure of geopolitical tensions, okay? That did keep prices relatively supported. Or we can see here, China is now even involved in this, proposing that Putin and Trump in their new summit set to end the Ukraine war. This is just a report. It's really detailed on the topic. It talks about how Trump met with President Putin and how China's floating the idea and the proposal around to hold a summit between Russia and China, Russia and President Donald Trump, along with the president of Ukraine, which is insane, to, come to terms in these peace talks. That is super positive because, collectively speaking, this has been one of the primary factors creating safe haven demand in the US dollar since 2021, right? So if this went away, this would be one of the factors that would actually weigh on the United States dollar, where larger investors than you and I have cash positions in dollars because of this geopolitical event, gravitating towards the dollar because of its safe haven status, and most likely end up sell their dollars. And I'm not necessarily saying that they're going to buy crypto, but they would buy risk assets. And when I say buy risk assets, I mean assets like GBP USD, Euro USD, right? They would probably buy crypto. They would probably buy stocks, right? Selling their premium positions in dollars and then putting that into riskier assets, i.e. the euro, the Great British pound, stocks, and then hopefully some crypto, right? So this is obviously, of course, extremely positive to see. And you can see fundamentals. It says the dollar could fall as upbeat geopolitical news outweighs the cautious U.S. rate cut bet. So this was obviously, of course, one of the things during higher inflation readings that kept prices relatively stable instead of seeing a massive sell-off in risk assets. Okay. Now, risk assets are still down on the day, right? We're down about $66 billion compared to the weekly high, but overall, that $3 trillion threshold has remained relatively stable. All right. So far, I just wanted to kind of cover for you guys. Let me see if I got everything. So we had the revision in the PPI to the downside, which showed that inflationary pressures, albeit yes, came out higher this month, last month were revised to the downside. We had commentary from Jerome Powell stating that even though inflation came out higher, one report does not deteriorate their sentiment surrounding later half of the year rate cuts. We had the market today pricing in a September cut instead of, compared to previous sessions, the market was pricing in a December cut, right? So the market actually brought up the prospects of a rate cut earlier in the year, albeit still in the second half, to September instead of December, right? We've had peace talks between President Trump and Russia on the Ukrainian situation. I can't sit here and say that we've had complete peace agreements in the Middle East between Israel and Iran, but we still have seen over the past month no relative escalation surrounding the geopolitical tensions in the Middle East, which has also kept prices relatively supported. Last but not least, the last factor supporting risk assets, you can see right here in this fundamental piece, it talks about the Dow Jones. The Dow Jones, obviously, of course, industrial average, is seen as a risk asset class. But it says here in this piece, the United States President Donald Trump is expected to deliver his latest batch of tariff threats during the back half of the U.S. market session. President Trump is slated to reveal details of his planned reciprocal tariffs. He mentioned that on his Truth Media social platform or whatever it is, on any country that has their own tariffs on U.S. goods. But according to according to reporting from Washington, D.C., this can get preemptively kicked down the road with reciprocal tariffs not expected to come into effect for some months. Markets are getting used to brushing off trade war threats from Donald Trump And this represents the fourth consecutive time that the Trump administration has threatened imposing steep import taxes on foreign goods and has been announced, but then delayed. So the market, like I mentioned in a previous Zoom call, it seems that every single time we have some type of tariff threat, it weighs on prices temporarily, but prices bounce back the day or two right after, right? Or it really only is like a week's worth of price action that's bearish, and then the market tends to bounce back, right? So collectively as a whole, we have market shaking off tariff implications. We have peace talks from Russia and President Donald Trump on the Ukrainian situation. We have easing tensions in the Middle East. We have the market kind of shaking off this high inflation because of Jerome Powell's commentary to the market stating that one high inflation report is not going to deteriorate rate cut bets. We have today's inflation coming out with a revision to the downside that pushed up the rate cut from December and previous reports up to September, right? And then we also have physical proof that these large financial institutions still hold a risk-on perspective, okay? So as a whole, I just wanted to show you guys why my previous analysis that as long as price holds above this $3 trillion threshold, which we can see on the higher time frames, has remained a very, very important buying point for these larger market participants, right? Every single time prices come down into this $3 trillion range, these people that move the markets usually tend to buy. So we still need to be cautious. We still need to continue to remain data dependent. I'm not marrying a bias stating that we are not going to break this threshold. I've continued to tell you guys that if we do, it is most likely that we are going to see some type of liquidation event